Good afternoon, everyone. I hope you're all keeping well. On behalf of KPMG, I would like to welcome you to our first webinar in our Lunch and Learn series. The series will focus on a variety of topical tax issues facing finance and tax professionals and will run for roughly 45 minutes over lunch. Today's webinar will focus on COVID payroll-related tax and legal matters that businesses need to consider as they look ahead. No doubt more changes and details will emerge next week as the government announce their stimulus package, and we will keep you appraised of these developments as they are announced. But for now, I'm going to hand you over to my partner and Head of People Services, Owen Quigley, to kick things off. Thanks. Over to you, Owen.
Thank you, Tom. Our topic today, focusing on COVID-related employment tax matters, does follow on from our previous webinars on this area. But it's been an extremely dynamic area, and it's been an area where our teams have been inundated with queries to assist clients over the past few months. So today, Olive is going to kick off with an update on the COVID subsidy itself. Claire will go into some operational matters. And then Talia is going to focus on some of the workforce shaping considerations that are arising as we move through this COVID scenario. And Aoife will follow on with some of the legal considerations related to the same. The presentations will be relatively quick. Our aim is to have this webinar no more than 45 minutes. So we do hope to have time for some questions at the end, but there is a Q&A button at the bottom of your screen. So we would urge you to input your questions as we go through, and we will do our best to get to the questions at the end. To the extent that we don't, we will get back to people as we have done in previous webinars after the event. But in the meantime, we'll get started. So I'll pass on to Olive for the first presentation. Thank you.
Thanks, Owen, and good afternoon, everyone. So if we just move on to the first slide there. So as many of you will be aware, the Temporary Wage Subsidy Scheme has now been extended in its current form until the 31st of August 2020. On the 23rd of June, Revenue issued an e-brief with some updates and clarifications in relation to the extended period, with the two main points being that the employer eligibility criteria will remain unchanged and the calculation and the level of the subsidies will remain the same also. It is also helpfully still possible for those employers that have not yet availed of the scheme to now enter the scheme up to the end of August. Lastly, the e-brief does outline Revenue's intention to issue employer compliance checks to all employers who have availed of the subsidy scheme. And we now know that a number of you have already received those letters and we expect more to follow. So just by way of recap in terms of employer eligibility, in order to be eligible for the subsidy scheme, the business of the employer must be significantly adversely affected by COVID-19 such that the employer is unable to pay wages as normal. And effectively, this test was demonstrated through either a 25% reduction in turnover or customer orders received by the employer or another reasonable basis as an employer might determine. Also at the outset, Revenue made it clear that on entering the scheme, employers had to have firm intention of continuing to retain the employees in their employment and pay them some wages where possible. So as I mentioned, the employer eligibility criteria throughout the extended period, it has remained the same. So in other words, the 25% decline in Q2 is still the test that applies, and there's no need to consider decline in turnover, etc. in July and August. That said, the updated guidance is silent on the inability to pay wages, but saying that, we would still be of the view that that hasn't disappeared, and it should still be something that's considered by employers in the context of a decision to remain within the scheme. The inability to pay wages test is probably the area of the scheme that's created the most uncertainty and confusion, given the lack of any detailed guidance in that area. But just to remember what Revenue had put in prior guidance is that, notwithstanding that an employer may have surplus cash not needed to fund debt, such employers could still qualify for the scheme, but there would be an expectation that those employers would continue to pay a significant portion of the wages. So just then moving on, I guess that the main consideration now for employers is as to whether it's appropriate to stay in the scheme or consider withdrawing from the scheme. So throughout the whole course of the subsidy scheme and the various webinars Revenue has participated, there's always been this overriding theme of a presumption of honesty on the part of Revenue. And they have acknowledged on a number of occasions that, you know, they appreciate that employers did have to enter into the scheme under very unusual and uncertain circumstances. And they would take a pragmatic view in assessing employer eligibility when it comes to the review stages. So now that we're at the end of Q2 and into July, it is really important that employers go back now and review actual Q2 performance and to consider where actual performance lies now as against the comparator period that was used on entering the scheme. Revenue have made it clear that where a 25% decline in Q2 has not been met, that employers should leave the scheme immediately. And Claire will touch on that in a little bit more detail. They also have said that in those circumstances, Revenue would expect that employers would provide evidence of the assumptions that they used for their projections at the outset. And once those projections were considered reasonable, Revenue would not seek repayment. In contrast, if those projections were not considered reasonable, it's likely that Revenue would seek repayment of the subsidy in full. On the other hand, then, if the 25% decline in Q2 has been met, then I guess it's a case for employers to consider whether it's still appropriate to remain within the scheme, given all the various facts and circumstances. So just moving on then to some of those additional considerations. So it would be worth kind of having a think about, well, you know, the cash forecasts for the period of July and August, and pulling those forecasts that were already prepared on entering in the scheme all the way forward to August to consider what the impact would be on the business in the event that the subsidy wasn't continued to be claimed. Similarly, it is worth giving consideration to how the business is actually performing now in July and expected to perform in August, given the reopenings and the relaxation of various restrictions, and whether wages could reasonably be expected to be paid out of incoming revenues in July and August. One litmus test I've certainly followed throughout the course of the scheme in kind of assessing and assisting employers in determining whether that ability to pay wages test is met, is to consider, in the absence of the wage subsidy scheme, what would that result for the business? So would it result in additional layoffs, further pay cuts, etc.? And if the answer to that question is yes, then that certainly would seem to be a supportive factor of that inability to pay wages piece. Also really important, I think, just to bear in mind that assessing employer eligibility is not a once-off assessment, and Revenue have kind of stressed the importance of employers continuing to monitor eligibility throughout the extended period. As we would have mentioned on previous webinars, it is just really important that all employers within the scheme maintain comprehensive and robust files around both entering the scheme, but also around the decisions to remain within the scheme. So just then moving on, lastly, to the employer compliance checks. So many of you will have already received these compliance checks from Revenue, and effectively these standard letters are being issued by Revenue in order to allow Revenue to confirm that the employers firstly meet the eligibility criteria, that employees are receiving a correct amount of subsidy, and that the subsidy amount is being correctly recorded on employee payslips. So for those of you that have received the letters already, there is a 5 business day turnaround, and these letters are being issued within the Ross inbox. So we would recommend that you have someone keep an eye on those Ross inboxes. Now, we are aware of some clients getting an extension on that 5 business day turnaround. And if that's something that you think you would benefit from, I would suggest that you contact Revenue as soon as possible on receipt of that letter. Also, just to note that Revenue did outline in the e-brief at the end of June that they will be using the compliance checks as an opportunity to address any issues identified by them in respect of real-time reporting throughout 2019 and 2020. Lastly then, just for those businesses and employers looking to avail of the debt warehousing scheme for PAYE and VAT, Revenue again have said that it is important that such employers would have up-to-date compliance records for, in place before availing of that scheme. So with that then, I will just pass you on to Claire then to deal with some of the operational updates.
Thank you, Olive. Since our last webinar, Revenue released several updates on their FAQ guidance on the operational phase of the scheme, together with a detailed debrief covering a number of important updates relating to the scheme. So today I'm going to take you through some of the key operational updates, clarifications and enhancements to the scheme. I'll then cover some of the practical payroll tax matters arising from participation in the scheme. And finally, I'll touch on some of the key employee considerations employers may wish to communicate to their employees over the coming months. So what are the main updates on the operational aspects of the scheme? So firstly, whilst the core employee eligibility criteria remains unchanged in keeping with Revenue's main objective of maintaining the link between the employer and the employee, this scheme has now been extended to include certain categories of employees previously ineligible from the scheme. So for example, number 1, those returning to work after a period of maternity or similar leave. Number 2, employees in receipt of illness benefit from the Department of Social Protection. And number 3, trainees or apprentices who were participating in education and training programs run by SOLAS in February. Revenue have now established a new system to process these cases, and employers who wish to access the scheme on behalf of these employees should complete a short online form available through My Inquiries on ROS. Revenue will then determine the employee's average revenue net weekly pay, max subsidy and max employer top-up payment, and this information will be included on the employer's CSV file going forward. Secondly, Revenue clarified the position on the availability of the scheme in cases of redundancy. Some employers will unfortunately have no other option but to reduce headcount by implementing redundancies. In order to mitigate against the potential negative impact on employees' net pay, helpfully, Revenue have confirmed to the Institute of Tax employers can continue to avail of the scheme up to the employee's leave date, notwithstanding a decision has been made to sever the link with the employee. This is a very positive development and will help to alleviate some of the financial burden on employers during this difficult time. Thirdly, Revenue have provided additional guidance on the processing of rehired employees. With businesses reopening and employees re-entering the workforce, re-engaging staff previously laid off will become more common in the recovery phase. To ensure the smooth processing of rehired employees, Revenue have provided additional guidance on the steps an employer should undertake when including rehired employees under the wage subsidy scheme. It is important that employers follow these procedures when placing employees back onto the payroll to ensure the correct subsidy payments are processed. Fourthly, Revenue highlight the importance of using the information provided on the employer CSV file. During the operational phase, Revenue are providing all employers with the average revenue net weekly pay, the max subsidy payments available, and the max employer top-up payable under each tier for each eligible employee. This information has been made available in the form of a CSV file which can be downloaded via ROS. And whilst we expect most employers are downloading the CSV file into their payroll software, Revenue firmly recommends this facility is used. Where employers do not use the information provided on the CSV file, they run the risk of applying incorrect values which may be rejected by Revenue. And fifthly, Revenue clarified the position with regard to multiple employments. During the operational phase, earnings from all active employments, including occupational pensions, are combined and reconciled. Each employer is then provided with a max subsidy and max employer top-up to apply to all employee payrolls. This personalised information will ensure the employee's overall position is taken into consideration when calculating the employee's subsidy entitlement. And lastly, Revenue launched a new facility where employees can view subsidy amounts paid to their employer, including amounts reported in their payroll submission. And this facility can be accessed via My Accounts on ROS and will allow employees to reconcile subsidy payments on their payslips to the amounts showing in their My Account. Now moving on to some of the employer considerations. Whether an employer determines they are no longer eligible for the scheme, no longer wish to avail of the scheme, or they will remain within the scheme for the extended period, there are still a number of key issues and practical matters for employers to consider emerging from the scheme. So what do employers remaining in the scheme or entering the scheme for the first time need to be aware of? Firstly, the operational phase will continue to be in place until the end of the scheme and remains unchanged during this time. For example, there are no changes to the level of subsidy rates, and the rules for calculating the average revenue net weekly pay, max subsidy and max employer top-up payments also remain unchanged. Second, as businesses return to more normal levels, employers should be careful not to breach the max upper limits imposed under the scheme, which prevent employers from topping up above set limits. This upper limit is likely to cause challenges for many employers, who want to pay employees for actual hours worked, but employees' average revenue net weekly pay is not reflective of their normal or usual net pay. Employers are reminded where they pay above the employee's average revenue net weekly pay, a subsidy payment will not be paid and payments to employees should be processed through the PAYE system in the normal manner. And finally, with the continuation of the scheme to assist employees in minimising any future potential tax liabilities, Revenue have automatically placed all employees in receipt of the wage subsidy and PUP payments on a week one, month one tax basis. In light of this, employers should ensure they are using the most up-to-date revenue payroll notification prior to running the payroll. So next, what do employers exiting the scheme need to be aware of? Firstly, employers must formally notify Revenue via My Inquiries they intend to exit the scheme. Secondly, employers should also ensure they immediately cease Class J9 PRSI and employees' PRSI pre-COVID should be included on any future payroll submissions. Thirdly, employers should also retain all records relating to the operation of the scheme, including all subsidy payments made to employees, and this will help to simplify the handling of any follow-up queries as Revenue commence their programme of compliance checks and begin the reconciliation process over the coming months. And lastly, there are also some additional considerations employers may need to address on exiting the scheme. For example, BIKs and notional pay values, which were either altered or suspended for the duration of the scheme. These should now be reinstated and spread over the remaining payroll periods where possible. Where this is not achievable, suspended BIKs should be reported before year-end, and employers will need to factor this into their year-end payroll process and procedures. Employers may also need to consider employees' non-statutory deductions which were also altered or suspended for the duration of the scheme, for example, pension, local property tax, and union subscriptions. Employers should now consult with their employees to determine whether deductions should be reinstated and whether any catch-ups are required in the remaining payroll periods. And this is most likely to be relevant to employer and employee pension contributions, and both parties may wish to consider making non-ordinary or special contributions. And finally, just to touch on some of the employee considerations, employers may wish to communicate to employees before the scheme ends or indeed prior to year end. For example, the impact of the wage subsidy scheme on the employee's net pay after the scheme has ended, including any reinstated BIKs and notional pay values in the remaining payroll periods. Employers may also wish to communicate week one, month one tax bases to employees entering the scheme for the first time in advance of the first payroll. Employers may also wish to notify employees of the online facility available via My Accounts, particularly as this will form the basis of the tax due following year-end review. And lastly, while payments made under the scheme are not taxed in real time through payroll, they remain liable to tax by way of year-end review. And in light of this, employers may wish to communicate and assist employees with the calculation of estimated year-end liabilities arising on wage subsidy payments. Regardless of what is relevant for a particular employer, clear and concise communication with employees will be key, and this will help to manage employees' expectations and avoid any unnecessary surprises after the scheme is ended and before year end. So as you'll have heard, there are a whole host of payroll tax matters emerging from the scheme, and given the end date is on the horizon, we recommend employers get in front of these matters early to ensure a smooth and seamless transition to the recovery phase. I'm now going to hand you over to my colleague Thalia, who will discuss some workforce shaping. Thank you.
Thanks, Claire, and hello everyone. So I'd like to talk to you today about the different ways we're seeing companies reshape their workforces, focusing on remote working and downsizing. As a result of COVID-19, we've seen a change in the work location for many employees, and remote working is expected to become the new reality, as demonstrated by some of the quotes shown here from several CEOs and other business leaders over the last few months. This change creates additional questions for businesses in terms of the size and role of the HR function, the total reward on offers to employees, and operational requirements, such as investment in technologies. But today I'm going to focus on the broader employment tax considerations. So moving on to working from home. You'll be aware that Irish Revenue have set out some specific tax reliefs which will apply for the duration of the pandemic period. Now, a question does arise as what is meant by the pandemic period, and there's no specific definition nor end date set out in current guidance. As businesses reopen and employees return more fully to work, it's important to step back and revisit the normal place of work concept and the ongoing availability of these reliefs. For example, on company cars, revenues were very clear that employers who either prohibited use or have taken back possession of the vehicle, there would be no BIK for that employee. And to the extent the employer allows private use, by concession, once limited or no business mileage is undertaken, the January 2020 BIK rate can be used for payroll purposes. It follows that where the employee begins to resume working with the car, employers need to revisit the BIK calculation using real-time information. In terms of foreign employments, we're seeing more individuals who were due to relocate from Ireland and take up a new employment overseas begin to work from home here. And in that scenario, the concessions that apply to foreign employments during the COVID period do not strictly apply here, given that the employment now being performed in Ireland has no prior travel or work pattern outside of Ireland prior to the COVID-19 period. In such a case, we would expect that PAYE is due by the foreign employer, and in some cases, the foreign employer may ask the local entity to manage the payroll reporting obligations on its behalf. I also want to touch on the small benefit exemption. You will be familiar with the once-off annual tax-free benefit that can be provided up to a value of €500 per annum. And this exemption requires the benefit to not form part of a salary sacrifice arrangement, and also cannot be convertible into money or money's worth by the employee. So during the pandemic period, frontline and other key staff who continue to work during this crisis can receive an additional voucher under this exemption scheme. So we have seen employers looking for additional ways to reward their employees by sending out gifts or hampers to employees at home. And we expect that these should qualify for exemption once all other conditions under the scheme are met. However, to the extent that the employee is allowed to purchase an item online, or for example, enjoy a meal and then reimburse the employer for these costs, that would not qualify for exemption under this arrangement, and it would be a PAYE matter for the employer to consider, possibly through a PAYE settlement agreement for 2020. It's therefore really important to consider the parameters being applied to incremental benefits in order to avoid any inadvertent PAYE issues. Looking at some of the e-working reliefs, guidance does set out the meaning of e-working, which amongst other things must involve logging on to the employer's computer system remotely for work purposes. The relief includes reimbursement of office equipment costs and can include either a daily tax-free per diem of not more than €3.20 per day, or the employee can claim a pre-tax deduction similar to a pension contribution on their tax return for up to 10% of the utility costs arising during the home working period. The marginal income tax rate of the employee will determine the value of that deduction in cash terms to the employee. A formal agreement must be in place between the employee and the employer, setting out the partial or full-time remote working arrangements. And it's really important that any per diem that will be paid is documented as such in the agreement, as annual allowances are treated as regular pay for PAYE purposes. Revenue's view is that even if the employee is working full-time from home as an e-worker, the office remains a normal place of work for that employee. And so travel costs to get from home to the office would typically remain taxable. It's also worth noting, therefore, that calculation of business mileage for company car users or for mileage claims for private car users must consider the lesser of rule where the journey has started or ended at home. This means the mileage to be used must be the lesser of the distance calculated between the office and the temporary workplace, or between home and the temporary workplace. Company car logs and mileage claims should reflect this. Moving on to working from anywhere considerations. So we've seen additional flexibility to work across borders, and indeed decisions by employers to not send an employee on an assignment overseas, but instead bring the work back to the employee to work remotely from home. You may be familiar with the general rule of thumb, which provides that an employee can spend up to 6 months in a tax treaty location without paying tax once employed and paid outside of that country. As always, things are more complicated than that, and this general rule may not apply depending upon the tax treaty in question, the employee's level of historic presence or ties to that location, or whether the employee's activity creates a corporate tax presence of the employer in the overseas location. It also does not apply where working remotely from a location where there is no tax treaty in place. While the 6-month rule may apply for personal tax purposes, it does not cover any employer payroll withholding or reporting obligations in the overseas location, different country timeframes for making an application for tax reliefs, including tax exemption, social security considerations, given that social security is generally payable where duties are performed unless an exemption is available, immigration requirements, or the impact for corporate tax purposes. As a result, it is necessary for employers to review the locations in which their employees are based and also the personal circumstances for each employee to determine the payroll, reporting, and corporate tax compliance risks. For example, in addition to PE risk assessment for the overseas location, the impact on the existing corporate structure from having employees established outside of Ireland must be considered. As there may be personal tax implications for the employee from maybe tax return filing to different tax rates applicable to their employment income, employers may need to help employees understand their personal obligations and the impact on net pay. And this could be done by way of a one-to-one briefing or an FAQ document. We would typically recommend 3 aspects. Number 1, develop a policy to be applied. Who's eligible to work overseas? Who is prohibited, perhaps due to regulatory or tax reasons? What supports you will provide as an employer? What are the compliance processes to be undertaken before an approval to work remotely is granted? Number 2, consider the risk analysis across tax, social security, and immigration, and use this information to identify which countries will or will not be supported for remote working. And number 3, monitor your compliance risks on an ongoing basis so that you fulfill any employer withholding obligations. Many companies use technology tools which enable such analysis. KPMG Business Traveller is one such tool which provides a real-time traffic light warning system across all the relevant areas and supports actions required by the business. It's clear there's a lot to consider here, and with 4 months into lockdown, now is the time to revisit any remote working arrangements. So moving on to rationalisation considerations. This slide shows the typical sequencing should your business consider downsizing its workforce. Selection naturally is very important and will depend upon whether voluntary or compulsory redundancy will be operated. And employment considerations here are very important, as Aoife will discuss. Determining the package available to the employee using market practice, whether statutory redundancy is available, the payment split between statutory or ex gratia payments, calculations of available exemptions on the ex gratia portion of a payment, and the assessment of the net cash in hand available to the employee is all required. It's important that the tax aspects of the package are managed, as where payroll is not operated correctly, the employer is required to make good any underpaid PAYE should it arise on an audit. Communication with the employee of the termination needs to comply with notice and other employment law requirements, and crafting any agreements to support the tax position, including use of indemnities, are really important, especially where the employer has relied on information provided by the employee to support exemption calculations. It's at this stage the employer may offer a one-to-one meeting between the employee or the tax agent, and in which they can run through the net package position and discuss pension waiver options. Finally, appropriate payroll reporting and filing of a separate employer return by the 15th of February of all employees whose employment was terminated in the prior tax year is the final piece of the puzzle. Finally, moving on to common pitfalls. You will all likely be familiar with the exemption calculation process, so I thought it'd be worthwhile instead to focus on some common pitfalls that we see. In the interest of time, I'll focus on a couple of items. On package design, it's important to ensure that the design does not fall to be considered salary sacrifice arrangements, the impact being that PAYE and PRSI arises on the amounts foregone. On the timing of a pension waiver, this must be done before the termination date or is not considered a valid waiver, and the impact being that the taxable ex gratia amount for payroll purposes will increase and result in a PAYE underpayment otherwise. And finally, cross-border cases. These can be really complex as each country in which the employee has performed duties may wish to tax a portion of the package being paid out, with corresponding personal tax and employer withholding obligations. So care is really needed here. I'll now hand you over to Aoife to talk you through some employment law considerations.
Thank you, Talia. So just moving on, what we're going to cover as part of what we've just covered this afternoon in relation to employment law specific matters. We're going to look at a redundancy update. We're going to take a look at the scheme and what it means in terms of deductions and potential claims in this area. And then we're going to touch on mobility and the mobility of workers in terms of particular posted worker matters. And indeed take a look at termination agreements to make sure that you have the key ingredients to make these agreements work for you. So if we take a look at the next slide, we'll see the redundancy update as a result of the emergency measures in the Public Interest Act. So in April, there was a trigger that was put in place in order to ensure that a particular piece of the redundancy legislation, the original Act of 1967, couldn't be implemented by employees who were placed on either layoff or indeed short time. And that kind of impediment to the trigger of redundancy was originally up to 31 May. That's now been extended to 10 August. So it just gives employers a little bit more comfort that during this particular time, for those employees they still have on layoff or indeed short time, they cannot actually entitle themselves or claim their own statutory redundancy from the employer. So it gives a bit more breathing space to employers. As part of all this, then when the employer has to implement the redundancy rather than the other way around, they are asking an awful lot of questions in terms of subsidy scheme and what does this mean in terms of having to make people redundant while participating in the scheme. So at what point is the redundancy? The point of redundancy tends to be after your at-risk conversation. So in other words, at the very beginning, you're following through for procedures, you are approaching the employees at risk and explaining why they're at risk and looking for alternatives to redundancy. So this could be reduced hours or indeed redeployment options. It's at that point then, if there's no alternatives, that we have redundancy in fact. And it's at that point we need to consider what's the impact on the operation of the subsidy scheme. An awful lot of our questions in this area are relating to, do I have to consider the length of time that the scheme is actually running? Do I have to wait to give my employees the benefit of the scheme rather than implement redundancies now? And no is the answer, simply because redundancy, as I say, is a matter of point in time. So if somebody is genuinely redundant now, despite the fact that they're taking the scheme, they can be made redundant during the operation of the scheme. So very important that you progress with your business plans in the normal course. And then the next slide, in speaking of business plans, we know an awful lot of our clients have had to consider who they're going to have in terms of the resourcing that may be surplus requirements as their businesses reopen and resume normal trading. So as part of this, we're looking at some restructuring options, and there is always the option to extend the layoff period. So some are nervous about doing this because it's going on for a matter of months at this stage, but if the reasonable belief remains that the cessation of employment will not be permanent, and indeed it's only temporary, well then you can actually continue to have your employees on layoff, albeit through the scheme or indeed in receipt of the pandemic unemployment benefit. So whichever way is working for you, as long as you think it is still somewhat temporary, you can continue these arrangements. Very important then when you're considering those who are returning to work, that you're actually applying the same objective criteria, or sorry, not the same objective criteria, but the same objective approach to those returning into the workforce as you would for those actually leaving the workforce. Make sure that you're not getting into any cherry picking type disputes about who you've coming back in in order to gain more service or gain more pay, and that you're being fair across the board. And indeed, we're seeing an interesting increase of specific matrices in terms of redundancy selection. There's an increased focus on specific criteria, such as skills, experience, and performance. So obviously the traditional selection based on service of last in, first out, or first in, first out, which is naturally preferred by the labour force as a more objective approach, can still be part of the elements of your packages in terms of how you're approaching your redundancy programs. However, we're finding clients are now being a little bit nuanced in terms of exactly the type of skills that they need in the business going forward. And indeed, we're having some interesting discussions in terms of ex gratia payment models and the need to deviate from prior company or sectoral norms. So at a time where companies could provide more attractive ex gratia payments, maybe perhaps inclusive of the statutory amount, that may or may not be possible anymore. So we're exploring very different type of packages with our clients. Moving on to the next slide then, if we see as part of all this, an awful lot of our focus has been, well, what happens about employment claims as a result of being on the subsidy scheme, or indeed if subsidy scheme is our first port of call during the emergency period, what does that mean now for employment claims? So we're taking a look in detail now for our clients in terms of what is the exposure. So some had to do very commercial imperative emergency responses at the time, and now we're seeing how we might actually soften the blow in terms of any particular employment claims. We know that statutory claims are a possibility, most likely under the Payment of Wages Act of 1991, and indeed the more dramatic breach of contract claims for non-payment of wages. What we are looking at as part of payment of wages claims is indeed our bonuses payable. And so in other words, our bonus is considered as wages under the Payment of Wages Act, such that employees could actually bring claims, very easily brought claims, in terms of recovering bonus payments. And what we're looking at to see, well, is the bonus actually properly payable in order to fall within the definition of wages? And often it does, but you'll be looking at your bonus policies, your bonus provisions in your contract, and the general precedent set up within the company in terms of bonus arrangements. There is a possible defence in the 1991 Act to anything we're doing in terms of the scheme, and that is where we're being required to make deductions that are authorised by virtue of statute, or indeed an instrument made under a statute. So based on the scheme, we could say that if there are differences in terms of pay based on differences relating to gross or net income, we could be able to say, well, actually, there's a defence there that it's nothing to do with underpayment of wages. It is simply the washout of the tax treatment as a result of being in the scheme. So that's one possible defence. But even if it is an underpayment of wages in terms of maybe a unilateral deduction of wages that was done in an emergency setting without perhaps consent of employees, we are still hoping that any compensation award in this area will be minimal, if indeed nothing. And that's based on the fact that adjudication officers, or indeed the Labour Court of Appeal, can award compensation that they feel is reasonable in the circumstances. So there is a potential for nil awards, and we're quite confident that we will see those in particular circumstances where we're reflective of an employer who basically did their best in terms of the communications to employees and in terms of their file that they prepared, with probably mostly a view for revenue in terms of entry into the scheme to justify why they had to take certain actions. Moving on to the next slide then. Kalia has touched on this in terms of the wider immigration piece, and we're seeing quite a significant reduction in mobility. And in particular, there's a decline in the number of posted workers. So posted workers are workers who are sent from one EU member state to another, so including those coming into Ireland. And what we're finding is that they tend to be for small kind of duration, small projects, and perhaps a duration of maybe a few months. But because of the quarantine issues that we're currently facing at the moment, they're actually having an impact on the timing of postings. So if you have an employee coming in as a posted worker into Ireland to work in a particular plant, so they can't work from home, obviously it's not mobile working isn't an option, and they're coming in maybe for a 2 or 3 month project. They will actually have to self-isolate currently for the 14 days before they can actually go on plant safely. So we're dealing with that on our clients, and a lot of these kind of postings are actually being deferred. However, for those who are still entering into the country, and we're still dealing with some of them, it's important to remember that there's no suspension of compliance requirements in this area. And the WRC is still expecting posted worker declarations to be made for anyone coming into the country to do posted worker type projects. Now, this is by design, we'd say. So naturally, we know that there's some home workers working from different EU countries than they would normally do. So in other words, the employees who ended up in an EU country they weren't expecting. So there's less likelihood of a potential for a posted worker declaration to be made to either the WRC here in Ireland or any other authority across Europe on the basis that there's no actual posting, and indeed providing that the services that workers are still providing continued to be provided to the home entity. And then if we take a look, again touching on what Talia was talking about in terms of exit arrangements and exit agreements, as part of our COVID-19 related structures, our exit agreements are very much in focus. So this is basically an agreement where we offer anything beyond a statutory requirement. And it's important to reflect these additional benefits in a binding agreement. So as part of the binding agreement, naturally you're going to have your normal contractual requirements. So your offer, acceptance, intention to create legal relations, and indeed your consideration. So the payment under the agreement. And Talia has touched on this as well in terms of so important. There's no point in having a nicely worded legal agreement unless you have actually agreed the tax issues up front. So we need to actually specify out the payments, whether they're for notice, redundancy in terms of statutory or ex gratia, and actually make sure that we're agreeing the tax issues up front to make sure that the agreement is actually relevant from the payment and tax positions. And then obviously as part of the agreement, make sure that you've got a generic waiver. So obviously we naturally include any claims of common law, tort, or indeed contractual claims. And indeed make sure then we identify specific issues that we need to cover. So the specific legislation, so for instance, if an employee had a particular issue in the Maternity Protection Act or one of the other employment acts, we make sure that we actually list it particularly in the agreement so that they have a full awareness of what they're actually waiving or disclaiming. And as part of all this, in terms of their awareness, very, very important for you to make sure your agreement is watertight, is to make sure that they actually have advice. And if they don't get advice, that they've at least noted in the agreement that they've had the option to get advice. It doesn't have to be legal advice. It can be appropriate, whether it's through HR or indeed perhaps a trade union representative, but just make sure that in these agreements you are noting that the employee either got appropriate advice or indeed was given the opportunity to get that. And of course, the practical element or practical level, make sure the agreement works for you. If you are giving terms beyond the additional or beyond the statutory, make sure you've got your terms in surrounding confidentiality and other matters like non-disparagement to make sure the agreements work for you. At this point, I'll hand you back over for the questions and answers.
Thanks, Aoife. I think we just have time for one question. I think I'll direct it to Claire. What's your sense of when and how the revenue will perform the reconciliations with regard to the transitional measures, the way in which the €410 was provided to all employees in the initial phase?
Thanks, Owen. And this, Owen, is a question that we're getting, I suppose, from many clients at the moment. I suppose what we understand is revenue have yet to commence their work on the reconciliation phase, and their initial work is expected to commence in September. I do know from speaking to clients, this is an area of concern, particularly maybe where employees have paid a little bit over the average revenue net weekly pay in the transitional phase. We do understand from a podcast with Revenue and the Chartered Accountancy of Ireland that they are currently planning how best to approach the reconciliation phase, so that everyone's on a level playing field, which is positive. So just to note that Revenue, for employers who have reconciled their payments, Revenue have provided bank account details for making repayments, but in practice many clients are waiting until Revenue carry out their checks and balances on the reconciliation phase. So we do expect guidance to issue in this area very shortly.
Thanks, Claire, and thanks to everybody for their attendance and attention this lunchtime. I hope you found it to be a useful session, and I hope that you can join us for our next Lunch and Learn, which will be focused on the VAT considerations arising in these challenging times. That's scheduled to be on the 18th of August. So thank you again, and goodbye.